of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 2 Cost of Capital and Investment Decisions, Unit 7 Management of Working Capital, Part 1. After completing this unit, you will be familiarized with the concepts and components of working capital. You should be able to explain the significance and need for working capital, discuss the determinants of the size of working capital, and describe the criteria for efficiency in managing the working capital. Introduction. Effective financial management includes, among other things, the proper management of cash invested in a business. These funds can be used for a variety of purposes, including the purchase of fixed assets, business diversification and expansion, plant and machinery renovation or modernization, and research and development. Further, finances are also required for short-term purposes, that is, for running the day-to-day business activities. For example, if you are a manufacturer, you will need to plan for the purchase of raw materials, the payment of workers' wages, and meeting day-to-day expenses. It is possible that not all the things produced during each time will be sold immediately. As a result, some commodities such as raw materials, semi-finished or manufacturing in process goods, and finished goods remain in stock. As a result, the monies are held in various types of inventory. Again, not all the finished goods stock may be sold for cash, part of it may be sold on credit. Credit sales also entail holding monies with debtors until payment is obtained or the bills are collected. Working capital is defined as a company's investment in short-term assets such as cash, short-term securities, accounts receivable or debtors, and raw materials, work in progress, and finished goods inventories. It can also refer to the portion of a company's total capital that is used for short-term activities. Working capital, in simple terms, is the investment required to continue the business's day-to-day operations without interruption. Therefore, working capital management is just as vital as long-term financial investment management. Significance of working capital. You will be hard-pressed to find a business that does not require some form of operating capital. Even a properly equipped manufacturing company will fail if it lacks, number 1, enough raw material to process, number 2, enough cash to pay bills, and number 3, the ability to wait for a market for its finished goods, and number 4, the ability to extend credit to its clients. Similarly, a business would be worthless if it did not have items with which to sell its goods. As a result, the working capital of a company is its lifeblood. In fact, without appropriate working capital, any organization, profit-oriented or otherwise, will be unable to carry out day-to-day company activities. Operating cycle. The operating cycle or working capital cycle is the period of time between the procurement of raw materials or product and their conversion into cash. The monies invested in activities are recycled back into cash as per the operating cycle. The longer the conversion period is, the longer the operating cycle is. Obviously, the shorter the operating cycle, the lesser the amount of money that is invested for various intermediate activities. Current assets are investment types which can be made using short-term sources such as bills payable, creditors, trade credit, bank overdrafts, ongoing expenses, and so on, all of which are referred to as current liabilities. The available funds may be greater than the requirements for investing in various types of assets at times. For example, inventory, receivables, and essential cash balance. Concepts of working capital. There are two concepts of working capital, viz. Gross concept and net concept. Gross working capital. Working capital, according to the gross definition, is the firm's investment in current assets. Working capital and the total of current assets are viewed as interchangeable terms in this idea. This notion is also known as circulating capital or current capital. The proponents of the gross working capital concept advocate for certain reasons. They are: number 1. Profits are generated from assets that are partially fixed and partially current. Fixed and current assets have certain similarities as both of them are partly financed with borrowed funds and are intended to provide earnings over and above the interest cost. The logic thus dictates that the total of current assets be interpreted as working capital. Number 2. The total current assets are more important to the management than the sources of funds, since they represent the entire money available for operating purposes. An increase in overall investment in the business also results in an increase in working capital. Net working capital. The difference between current assets and current liabilities is referred to as net working capital. Current liabilities are external claims that are projected to mature for payment during an accounting year, such as creditors, bills payable, trade credit, bank overdraft, and outstanding expenses as discussed earlier. It is possible for net working capital to be positive or negative. A negative net working capital arises when current obligations exceed current assets, while a positive net working capital arises when the opposite is true. Current assets should be sufficient to cover current liabilities, forming a margin or buffer for commitments due during a business's normal operating cycle period. A company's solvency is jeopardized by a lack of liquidity, which makes it risky. Excessive liquidity, on the other hand, is not beneficial for business and may be related to mismanagement of current assets. As a result, management should take immediate and timely action to correct the firm's liquidity position. The concept of net working capital also encompasses the issue of a well-balanced mix of long and short-term finances for financing current assets. Every business has to have a fixed portion of net working capital. As a result, Permanent sources of money such as owner's stock, preference capital, debentures, long-term debt and retained earnings should also be used to pay a portion of working capital. Managements can determine whether current assets should be supported with equity or debt capital. The experts in finance uphold the net working capital concept in support of their stand, and they state that number 1. In the long run, what matters is the surplus of current assets over current liabilities. Number 2. This concept helps the creditors and investors to judge the financial soundness of the enterprise. Number 3. It is the axis of current assets over current liabilities which can be relied upon to meet contingencies since this amount is not liable to be returned. And number 4. It ascertains the correct comparative financial position of companies having the same amount of current assets. The gross and net conceptions of working capital can be considered two fundamental aspects of working capital management. Both notions are operationally important to management, thus neither should be overlooked. The gross idea of working capital stresses the quantitative aspect while the net notion emphasizes the qualitative. Kinds of working capital. The working capital is classified ordinarily into two categories. Number 1, fixed, regular or permanent working capital, and number 2, variable, fluctuating, seasonal, temporary or special working capital. Fixed working capital. The operating cycle, which is a continuous process for creating items, is linked to the need for existing assets. However, the amount of money invested in current assets may not always be the same. Depending on the quantity of production, the demand for current asset investment may increase or decrease over time. Regardless of the number of operations, a certain minimum level of current assets is always required for the company to operate. Since this level of current asset investment is permanently tied up in the business, it is referred to as permanent, fixed, or regular working capital. It is permanent in the same way as investment in the firm's fixed assets. Fluctuating working capital. The need for working capital over and above the permanent working capital will vary depending on changes in production and sales, seasonal fluctuations, as well as unusual or expected circumstances might affect the requirement for working capital. Additional operating capital may be required to deal with fierce market rivalry or other unforeseen events such as strikes and lockouts. Additional operating capital may be required to fund any special advertising campaigns aimed at raising sales or other promotional activities. This additional working capital is called fluctuating, variable, seasonal, temporary, or special working capital because it is required to support changing business activities. Fixed working capital remains stable throughout time, whereas variable working capital fluctuates, sometimes increasing and sometimes reducing. The permanent working capital of a growing company may continue to rise over time. Permanent and temporary working capital are both necessary to support production and sales throughout the operational cycle. But temporary working capital is arranged by the company to address liquidity requirements that are only intended to last a short time. Components of working capital. You have already noted that working capital has two components, current assets and current liabilities. The current assets comprise of several items and the typical ones are: number 1, cash to meet the expenses as and when they occur. Number 2, accounts receivables or sundry trade debtors arise due to credit sales. Number 3, inventory of raw materials, stores, supplies and spares. Also, work in process and finished goods. Number 4, advance payments towards expenses or purchases and other short-term advances which are recoverable. And number 5, temporary investment of surplus funds which could be converted into cash whenever needed. A portion of the funds needed to finance current assets could come from credit purchases and deferred payments due to custom, usage, or payment arrangements. The remainder of the working capital requirement may be supplied through short-term borrowings from financiers such as banks. Current obligations refer to all of these items. The typical items of current liabilities are: number 1, goods purchased on credit. Number 2, expenses incurred in the course of the business. For example, wages, rent, electricity bills, interest, etc., which are not yet paid. Number 3, temporary or short-term borrowings from banks, financial institutions or other financiers. Number 4, advances received from the parties against goods to be sold or delivered or as short-term deposits. And number 5, other current liabilities such as tax and dividends payable. Current assets. Now, some of the major components of current assets are: number 1, cash. We all know that money is the most important factor in starting a business. As a result, capital is necessary to purchase fixed assets such as equipment and machinery, which enable a company to make items and generate revenue by selling them. Further, cash is necessary and invested in working capital. Enterprises need to spend on working capital as they must hold a certain quantity of raw materials and finished goods as well as provide credit terms to their consumers. Capital invested at the beginning of the operational cycle is freed at the end to finance new investments. However, the company will need more cash if it wants to purchase more fixed assets, expand its operations, or make a change in its working capital cycle, such as extending credit terms to consumers. The demand for cash is influenced by a number of factors, some of which are under the control of financial managers and others which are not. It is impossible to run a business without cash. Keeping the cash without a purpose costs the company either directly in the form of interest or indirectly in the form of income that could have been earned with the cash. Cash management in the context of working capital management refers to maximizing the benefit and minimizing the expense of storing cash. The ideal way to achieve the cash management goal is to shorten the working capital cycle, particularly the cash or bill collecting process, and invest the surplus cash in the most profitable short-term assets. Number 2, accounts receivable. Firms prefer to sell for cash rather than on credit, but in today's competitive market, they are compelled to do so. Credit is now so widespread in the purchase of goods and services that it is taken for granted. Accounts receivables arise as a result of the sale of products or the provision of services on credit. Business units demand credit from their suppliers to match their investment in credit supplied to consumers as consumers demand credit. Trade credit is the extension of credit from one business to another for the purchase of products and services. Though commercial banks meet a considerable portion of working capital needs, trade credit remains a substantial source of financing for businesses, and the accounts receivable generated by trade credit represent important investments. Carrying receivables includes both direct and indirect cost, but it has a significant value in terms of growing sales. Excessive amounts of accounts receivable cause a drop in cash flows and may result in bad debts, lowering the firm's profit margin. Therefore, it is critical to keep a track of and manage receivables on a regular basis. Number 3. Inventory. Inventory makes up a large portion of a manufacturing company's working capital or current assets. Inventory control, that is, physical or quality control and value control, is critical since inventories are important components of the costing process and can account for more than 60% of current assets. Inventory holding is beneficial since it satisfies a variety of aims and purposes, but too much inventory is undesirable because it costs businesses a lot of money. Inventory, which includes raw materials and other consumables, as well as work in progress and finished commodities, is a significant part of current assets. The extent of inventory holding is determined by a number of factors, including the nature of the industry, material availability, technology, business practices, price fluctuation, and so on. Holding inventory supports a smooth manufacturing process, price stability, and prompt client delivery. Inventory, like every other sort of asset, has a cost associated with it. This cost comprises the potential cost of monies held in inventory, storage cost, and stock out fees, among other things. To justify a certain quantity of inventory, the advantages of maintaining inventory must outweigh the cost. Number 4. Marketable securities. Although cash and marketable securities are not the same, they can be converted to cash at a moment's notice. Holding funds for longer than necessary indicates the company is losing out on potential revenue. Normally, extra cash is placed in marketable securities, which serves two purposes, viz., provide liquidity and earn a return. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.